Welcome to the UK Investor Magazine podcast, the latest on shares, markets and investments, now available on your Amazon Alexa.
Hello and welcome to the UK Investor Magazine podcast, now also available on the UK Investor Magazine mobile app. For today's podcast, we're going to be taking a deep dive into London-listed investment trust India Capital Growth Fund. We're going to be looking at the performance over recent years and what is likely to drive performance going forward. We're also, of course, going to be digging in to the impact of Donald Trump's tariffs and what they mean for India. And to do that, we're very kindly joined in what, of course, is going to be a very busy week for the managers of this trust by Gaurav Narain, who is the principal advisor at India Capital Growth Fund. Gaurav, thank you very much for being on the podcast today.
Thank you.
So, as I say, very much appreciate you coming on today. It's going to be a hectic period out there in markets. Of course, we're going to be discussing the implications of tariffs. But before we get into it, Gaurav, I think we should set the scene and give listeners some context as to the approach that the India Capital Growth Fund takes to Indian equity. So if you could give us an introduction, first of all, to yourself, but as well as the trust, please, that would be fantastic. Thank you.
Great. Thank you so much. Well, I've been managing Indian equities now for almost 30 years. And the trust in particular, I've been running since November 2011. And I'm based out of Mumbai in India. And really on the ground, looking at what's happening to India, bottom up. And in the trust, the strategy is quite unique in the sense that it's one of the few trusts which invest only in the mid and small cap segment of the market. Our entire belief is that India is a growth market, and all you have to do is write this growth story. So the focus really is to not make any mistakes, and the idea is buy good quality businesses. And by quality, I would say the first criteria is to rise with the right management. So corporate governance is a very key factor. The second is on the nature of the business, that it should be scalable and have some USP or entry barriers. And the third is on fundamentals, really very cash flow focused and very return on capital employed driven. So really the whole idea of the trust is to play the India growth story and not make mistakes and buy leading companies in the mid and small cap segment.
Thank you. That's a really interesting point and a really interesting way that you frame your approach to Indian equities, Gaurav, in not making a mistake and looking at the performance over the past 3 years that the trust has returned 41%. So far from making any mistakes there, that's a really respectable return. What were the key drivers there? If you look over the last 3 year period, maybe if you look at a macro, I know you're a bottom up, but if you could talk to the macro influences which have helped, and then maybe if you can touch on some of the stock selection, maybe the themes that you're looking at to drive that performance.
Yeah. So, as I mentioned that for India, the economy itself has been growing at 6 to 7% per annum. If you see the last 3 years, the real GDP itself has grown at an average of 8.8%. So our whole aim is to buy businesses which can leverage on this India growth story, and the focus of the fund is to buy any business which we own with an intent to hold it for at least 5 years. So the idea is buy quality businesses where the earnings can compound over time with a reasonable degree of predictability. So that's really what we've done, that the portfolio earnings itself typically compounds at 15 to 18%. And if you get that predictability in it, that itself should drive your returns. So the whole idea of the fund is buy these businesses which can compound over time. And it's in a market which is so large in the domestic economy itself, that the whole idea is don't make mistakes. Do not buy businesses which you do not understand or very globally linked, where you're really a taker of information, and just write the India growth story. So the whole focus is, very consumer centric, very businesses which are predictable, and where businesses are leaders in their sphere, so they have some pricing power. So while we play the mid and small cap segment of the market, you really find that most of the portfolio companies are the leaders in their segments. And also, if you see the portfolio, over 50% of the portfolio we've owned for over 5 years, many businesses for 8 to 10 years. And it's really the earnings growth story which really eventually drives your returns.
Thank you. So you mentioned there, Gaurav, the riding the India growth story. Now, if we're discounting tariffs for a moment, if we go back a week or two before these tariffs were announced and we saw the fallout in markets, that India growth story that you've been riding, say, over the last 3 years, 5 years, 10 years, does that look the same? Are the same dynamics there if you look out into the future?
In fact, it actually looks better. You may have a period of uncertainty over the next year thanks to the tariffs. But having said that, my fundamental belief is that the India economy should grow at a 6 to 7% real GDP for at least the next decade. And why I say that is that the Indian economy has already seen a very big transformation. You've had one, political stability. It's the third term of the Modi government. So, what that's implied is there's been policy continuity. The second aspect is that the infrastructure has improved dramatically. The government itself has trebled its capex spends over the last 5 years, and almost every infrastructure, be it roads, airports, railways, has doubled in this period. So the structural bottlenecks have disappeared. And the third is the digitization, and India has really been at the cutting edge on the digitization drive. And I would say India's digital infrastructure is amongst the best in the world. The difference is that India is, the digital infrastructure is owned by the government. So it's brought about huge efficiencies in the system. So really, structurally, I think the economy is already transformed, and now you're really leveraging on that, and yeah, you're seeing a period of both investment and consumption cycle. Don't forget, India is the largest populated country in the world, and it's also among the youngest populated population in the world. So really, there's no demographics challenge. So we're really entering a phase of both investment and consumption-led growth, which is why we are so confident about the next decade being possibly India's decade.
When I was reading through India Capital's website and trying to get a feel for your investment approach, there was something that jumped out at me, which was really interesting and very pertinent. Given where we are in the markets at the moment, and that was that the India Capital Growth, as a management team, believes that the stock market is efficient most of the time, and it looks for inefficiencies within markets for opportunity. When we're looking at what's happening with tariffs, do you feel that that is an efficient representation of what the implications are going to be for companies going forward in terms of the volatility that we've seen? Or do you feel that there is some inefficiency there, maybe some overreaction, and you actually seeing the volatility as an opportunity?
Well, we always look at volatility as an opportunity. Having said that, possibly this is possibly a phase where we are possibly the most uncertain about the earnings growth playing out in the next year. Not so much because of the direct impact the tariffs have happened in India, because India's instead more of a domestic facing economy, and exports is not a very big share. But it's really the indirect impacts which is worrying us more, be it China dumping into India, or a lot of slowdown because of European slowdown rather than American slowdown. So I think there is a element of uncertainty which puts a question mark on the valuations over the next year. But having said that, finally we're looking at businesses for the long term, and what we're really looking at is stocks which, from a 3 year perspective, look really attractive, and that's our focus right now. That we're seeing it as an opportunity to get into new ideas and businesses which we wanted to own, but waiting for the right valuations.
Thank you. You make a really interesting point there that India isn't a massive exporting country. So when you're looking at the portfolio, Gaurav, are there any companies, can you draw a line between those companies that are exposed to the tariffs and maybe those that may be a little bit more insulated? And what's your sort of overall view when you're looking at the portfolio? Are you pretty happy with your portfolio composition at the moment, given the introduction of tariffs on India?
Well, I would say, we've gone through it threadbare, and we would say that about 35% of our portfolio, which will have an export orientation, or some of them are very reliant on exports. But they're businesses where, they are very efficient. So they would be amongst the lowest cost structures. So the business is not going to get impacted in the longer term, but the short term is more, your worry is more about a big slowdown in the US or Europe, which affects everyone. So I would say I'm fairly comfortable with the portfolio. And structurally, you're not worried that, there can be a long-term destruction in any of these businesses. Short term is, it's too uncertain to say where the earnings will flow out or the revenues will flow. But as I said, the businesses which you own, which are global facing, we're really not worried about them over a 2 3 year period.
Of course, you've been in the market for 30 years, so you would have seen India go through a great number of cycles. And there had been some commentary, and if you're looking at the prices of Indian equities over the last year or so, there has been this view that the valuations have been pretty rich. How do you see that playing out? Do you see the tariffs maybe causing a bit of a reset there, and that was something that was probably overdue? Or do you feel that the underlying growth prospects of Indian equities actually warrants that higher valuation because they're going to be delivered on in terms of higher earnings going forward? So really the question here is about the overall valuation of the Indian equity market and what your views are there.
Yeah. Yeah, I would say the valuations had become expensive. And to give you a perspective, the average multiples for the Indian market has typically been in the 18 to 20 multiples on the price to earnings ratio. Uh, and it's if you look at it relatively, I think only the US market is at similar levels. But historically, India has always been higher valued than emerging markets because of the nature of the market, higher growth, higher return ratios. So that's really been the benchmark. But having said that, last year you saw a period of very high returns, not so much driven by earnings and more by re-rating. So at its peak, I would say towards September of last year, markets had hit almost a 23 to 24 times multiple. And this correction actually started from October last year itself. And I would say by Jan Feb, even before the tariffs came into play, the markets had actually come off almost 30 odd percent from the peak levels. So the valuation had already normalized. What you're seeing today is more of Trump rate related uncertainty, and clearly markets have come off a lot since then. But on pure valuations, I would say earnings is a shorter term challenge. If you take that out, I would say valuation of the markets are now fairly valued on a longer term basis and in line with historical valuations. So I wouldn't say there are excesses anymore, but clearly now you are seeing a lot more opportunities coming in, and the Trump tariff just opens up the avenues a lot more.
Sounds like there's a lot of opportunity out there in Indian equities at the moment. But what I'd like to do now, Gaurav, is actually drill down into the portfolio, if we may, and look at a number of companies that you may have been adding to recently or even reducing, just to give listeners a flavour for the types of companies that you hold within the portfolio.
Yeah, so to give you a perspective, typically we've owned about 30 to 33 portfolios, companies on an average. So it's a fairly concentrated portfolio. Having said that, this expanded last year to about 38 companies in the portfolio, more because of the valuation concerns that we started taking lower weights. Uh, but what we've seen is once the markets have corrected, we are again back to adding very interesting businesses. And to give you a perspective, 3 of the companies we've added more recently, one is a company called Titagar Rail. This is the largest manufacturer of rail of wagons for the Indian Railways for the freight business. And here they have the order book almost full for the next 3 years. But the real story is not on the freight wagons. It's more because they've now moved into the passenger side, both for metro rails as well as for normal passenger rail coaches. And they've got huge orders already for the same. And to give you a perspective, on the metro railway side, the capacity is increasing disproportionately. Today, there are about 17 cities which have set up metro rail networks in the last decade or so, and this is almost doubling over the next few years, and they've already won mandates for 3 cities. The same with the passenger railway side, where the Indian Railways is trying to convert the entire rolling stock over the next decade to the new breed of trains, and they won orders for that as well. So there's a lot of visibility of growth over the next 5 to 10 years, and it's a company which has strong return ratios of almost 15 odd percent, and growing. It'll grow its revenues at about 17-18% profits over 20%. Likewise, we bought another company called Elecon. This is the largest manufacturer of industrial gears. It's a market leader in India and growing, expanding rapidly on the export side of the business, where its strength is that it manufactures the widest range of industrial gears, right from small gearboxes to gearboxes for naval frigates, etc. So it's a high precision engineering industry, and here too you're seeing very steady state revenue growth of about 15%, with profits growth even stronger, and return ratios of almost 20%. uh, then if you move across, we have a very interesting business called Car Trade. This is I would say, a digital company, and this company is actually the leading marketplace for automobiles for B2B sales. It's really a marketplace. It's a platform company, and what's unique about it is that it virtually has 100% market share in the automobile business, and its model is driven by advertising, where car manufacturers, car dealers, second-hand dealers advertise on this platform because it has this massive consumer base. And this is a business which again is growing top line at 20% and has huge operating leverage. So its margins are almost what was about 15% 2 years back. Today that's almost 25, 26% and expanding further. So earnings are growing at over 40%. So these are the sort of businesses we are seeing that which we've added. And all of these we bought at a very good valuation simply because the markets have corrected. And so, again, these are businesses which you'd want to own for the next 5 years because they're such strong businesses in their own right, with strong leadership and great management teams.
That's fascinating, Gaurav. I mean, I think we could probably do a podcast on each one of those companies there. But I have got a question about the train company that you own. Having been to India a number of times myself and travelled on the trains there, it's of course a very popular way of transport there and getting around the country. Is it as popular as it once was? If people are moving between cities, and I think the question is here: is there growing popularity of flights between cities? What does that look like at the moment in India?
Well, I think both are booming. If you're traveling by Indian passenger rails intercity, it's not like the UK where you can just buy the ticket and travel the next day. Still a long waiting list. So that gives you the potential that there is on this side. In fact, the Indian government has just built a 1500 kilometer railway track just dedicated to freight. I mean, simply because they want to free up capacity in the passenger network. So it's a market which is growing rapidly. I think travel is a big segment of the market, and the railways are just trying to keep pace with the demand. So it's quite a unique market. The demand is endless. Coming to the air traffic side, also that is also booming. And to give you a perspective, the Indian Airlines have a backlog of 1,600 planes ordered with both Boeing and Airbus. So if you speak with any airline in India, they're all complaining that we don't have capacity. So, the I think travel market in India is booming, and I think that's going to stay for a few years, for several years, simply because income levels are rising. and a lot of this is just domestic travel.
Thank you, Gaurav. So, in summary, here now we're going to look past the tariffs and any nervousness and unease it's causing it in markets, and we're going to look forward to. I'm going to ask what excites you the most about the year ahead from where you're sitting as an investor in Indian equities.
Look, I think India is going to be the most insulated economy in this tariff wars, simply because it's a largely domestic facing economy. So, relatively, India is better off. Two, a lot has already happened to kickstart the domestic growth. So, really, I would say India is still the best positioned market, and it's a decade long growth story. So, the Trump tariffs and the uncertainty is just giving you opportunities to enter into great businesses. So really, our mindset today is what to buy, and we're really sitting on I think 4 to 5% cash, and we're really itching to get into certain businesses which we want to own for the long term, and at the right valuation. So I think it's a great opportunity. Valuations have corrected. The uncertainty is giving you these opportunities, and I think we are very convinced on the long term India growth story. So that's what really exciting us, that this is a great time to be sitting on a bit of cash and looking at entering some of the great businesses which we've already identified. Really, it's just about when do you want to put the money in.
Indeed, it sounds like you've made some deft moves there, Gaurav, in terms of raising some cash for opportunities like this. And it's a breath of fresh air to hear some enthusiasm about the outlook, given what's happening out there in markets. So just as a note to listeners, do check out the notes to this podcast, because there'll be a link through to the India Capital Growth Fund's website. You'll be able to find further information, download their fact sheet, and get a better insight into what they're doing as a fund. So, Gaurav, thank you very much for being on the podcast today.
Great. Thank you so much.
And thank you very much to everyone for listening. Thank you.
We hope you enjoyed listening to the UK Investor Magazine podcast. Please do share the podcast, and we really value any reviews and comments you leave us in your chosen podcast player. The views presented by the hosts and guests of the UK Investor Magazine podcast are in no way investment advice, and please remember all investment involves risk.